Welcome to The Deep Dive, your shortcut to getting smart on the latest earnings insights. Today we are unpacking the second quarter 2025 earnings from S&T Bank Corp. They're a regional player and definitely navigating a pretty dynamic financial landscape right now.
Yeah, absolutely. We got some really interesting stuff from their callback on July 24th. It paints a compelling picture. You see incredibly strong internal fundamentals, really solid operational discipline.
Right.
But then the market reaction right after was, a bit mixed. It suggests investors are maybe grappling with some other questions, even with the strong performance.
Okay, so that tension. Strong results now versus maybe future strategy questions. That's what we're digging into.
Exactly.
Okay, let's dive right into the headline numbers then. S&T Bank Corp's Q2 2025. What did we see?
All right, so GAAP EPS, that came in at $0.83. That comfortably beat the consensus estimate, which was $0.81.
Okay, a beat on EPS. Good start.
And total revenue, so that's combining their net interest income and non-interest income, hit $100.1 million. That also surpassed the $99.18 million consensus.
So beats on both top and bottom lines. Pretty clear outperformance right there.
Definitely. And what's fascinating, I think, is digging into that net interest income, the NII. That's, the core profit from lending.
Yeah.
It climbed a strong 3.9% just from the previous quarter. And even more impressively, their net interest margin, the NEM, that spread, expanded by 7 basis points.
7 basis points. Wow. To what level?
Up to a really robust 3.88%, and that's on a fully tax equivalent basis.
Okay, 3.88% IAM is strong in this environment.
It really is. Plus, they saw solid loan growth too, about $98.1 million, which annualizes at just over 5%. And deposits, 8th straight quarter of growth there, up $28 million.
Okay, those are definitely compelling numbers. Strong NII, expanding NAM, good loan growth, consistent deposit growth. It points to really solid execution. But like you said, that initial market reaction was a bit lukewarm. So what gives? What factors might be, tempering that enthusiasm?
That's the million-dollar question, isn't it? The market often looks past just the headlines, right? It's looking at guidance, strategy, potential headwinds down the road.
Got it. So let's get into that nitty-gritty. What drove that really impressive margin expansion? How'd they manage that NIM growth when a lot of banks are feeling squeezed?
Yeah, the NIM expansion was mostly what they called effective spread management.
Spread management, okay.
It's not just about rates going up. It sounds like pretty proactive balance sheet work. Essentially, their asset yields were repricing higher.
Right.
While their interest-bearing liability costs, especially from CDs resetting, actually ticked down a bit, about 3 basis points.
Oh, interesting. So costs went down on some liabilities.
Yeah. And they specifically pointed to a securities restructuring they did at the end of Q1, giving them some extra benefit. Plus, just overall loan repricing added about 16 basis points to yields.
So earning more on assets, paying a bit less on some liabilities. That's a powerful mix.
Definitely a textbook case of managing the spread well.
But sometimes, focusing too hard on margin can mean maybe slowing down on growth. Did they have to sacrifice loan expansion for that NIM, or did they manage both?
They actually managed both, which really speaks to their strategy, I think.
Okay.
Loan growth was significant, like we said, over $98 million. Commercial real estate, that includes multifamily and retail, added a solid $58 million. And their mortgage and home equity businesses chipped in another $26 million.
Right.
However, and this is where it's interesting, commercial industrial loans, C&I, those balances were flat for the quarter.
Flat C&I.
Yeah.
That is interesting. That's often seen as kind of a bellwether for business confidence, right? So what are they doing to maybe jumpstart that segment?
Absolutely. Management specifically noted they've increased calling efforts, and they have robust pipelines for C&I.
Okay.
The total commercial pipeline, they said, is about 60% commercial real estate and 40% C&I, so the focus is definitely there.
Right.
And they've even added 4 new commercial bankers just since the start of Q2. One is a new C&I team leader in Central Ohio, specifically hired to drive that business.
Dedicated resources.
Exactly. They expect those efforts to really start showing results in Q3 and Q4.
And on the other side, deposits. You mentioned growth there too.
Yeah. 8th consecutive quarter of customer deposit growth, $28 million this quarter, mostly from CDs and money market accounts. But notably, their non-interest-bearing demand deposits, DDAs, basically free funding for the bank, make up a strong 28% of total deposits, and those actually grew by $18 million.
Growing free money is always good. So how are they funding the loan growth alongside this?
Well, they did increase borrowings by about $55 million to support that loan growth, but they stressed they're still maintaining really robust capital levels. Seems like a balanced approach.
Okay, balancing growth and stability makes sense. Speaking of stability, what about asset quality? With loan growth, you always wonder, any red flags popping up?
Quite the contrary. They use the word pristine to describe asset quality.
Pristine. Yeah. Okay, that's confident language.
Yeah. Non-performing assets, NPAs, actually fell to just 0.27% of loans and other real estate owned.
Wow, very low.
And their allowance for credit losses, the ACL money set aside for potential bad loans, also ticked down slightly by 2 basis points to 1.24% of total loans. Net charge-offs were pretty modest, just $1.2 million. Their focus now, they said, is just stabilizing these already exceptionally low levels. So strong risk management, very healthy portfolio.
Okay, incredibly strong. Pristine asset quality, low charge-offs, solid loan growth, great NI. On paper, S&T looks fantastic, yet that market hesitation persists. So if the core fundamentals are this good, what else could be weighing on investors' minds? Maybe things beyond the immediate numbers.
Exactly. It suggests the market's looking forward, thinking about strategy, future shifts.
Right. So the core engine's firing on all cylinders. But what about the other parts? Non-interest income and, of course, expenses. How did they look?
Non-interest income actually rebounded nicely, up $3.1 million.
Oh, good. Why the rebound?
Mostly because that securities repositioning loss they took in Q1 didn't happen again. Plus, they saw a sort of seasonal uptick in consumer activity.
Okay.
They expect that segment to kind of stabilize around $13 to $14 million per quarter going forward. So it's a solid baseline there.
Got it. But I thought I heard expenses were up. What was going on there, and could that be part of the market's caution?
Expenses did increase, yeah. Up $3 million from Q1, and it was primarily in salaries and benefits.
Ah, okay. Why the jump?
A few things hit at once. Annual merit increases took effect in Q2. Performance incentives were higher because, well, the results were strong.
Right. Makes sense.
And they had a bigger than usual jump in self-funded medical expenses, about double what they normally see in Q2, though that partly offset a lower Q1 number.
Okay, so a confluence of factors. What's the outlook for expenses?
They're guiding to a quarterly run rate of about $57 million to $58 million for the second half of the year.
Yeah.
So, yeah, maybe the market is watching that expense line closely for control.
Okay, so strong financials overall, but rising expenses. This leads us right into strategy, especially capital. They have really strong capital levels, you say.
Extremely strong. Their tangible common equity ratio, TCE, is over 11%.
Over 11% TCE.
And they explicitly said that's, quote, well more than needed to run the bank.
Okay, so they have excess capital. What's the plan? Just organic growth probably won't soak all that up.
Exactly. Internal organic growth alone isn't enough to deploy it all effectively. So they are actively, and I mean actively, pursuing inorganic growth, mergers and acquisitions.
M&A.
Right.
That's a big strategic shift the market would definitely be watching.
Absolutely. It's a key part of the strategy now, a top priority, they said.
What kind of deals are they looking for? What size? Where?
They're targeting banks in the $1 billion to $5 billion asset size range.
Okay, decent sized targets.
Yeah, and within their core markets, so Pennsylvania, Ohio, but also extending down into Virginia, Maryland, and the D.C. area.
Right.
And management seems comfortable letting that TCE ratio come down, maybe to around 9%, perhaps even a bit lower, if they find the right deal that's accretive and generates good returns.
Makes sense. Deploying capital effectively, but there's that $10 billion asset threshold looming, isn't there? The Durbin hit. Can you remind us what that is?
Right, the Durbin Amendment. It's part of Dodd-Frank. Once a bank crosses $10 billion in assets, there's a cap on the interchange fees they can charge merchants for debit card transactions.
Ah, the swipe fees.
Exactly. For a bank like S&T, that's a real revenue hit. They estimate it could be around $6 million to $7 million annually.
Ouch. That's significant. How are they preparing for that?
Well, management feels they've largely done the necessary infrastructure building already. They don't expect big jumps in operating costs or staffing just because they crossed $10 billion.
Okay, so they think they're ready operationally.
Yeah. They did mention they might consider some short-term actions to maybe stay just under $10 billion temporarily if organic growth puts them right on the edge, but only as a timing thing, not a long-term strategy to avoid it.
Got it. Timing the crossing, perhaps coordinating with an acquisition?
Potentially.
So what's their outlook for the rest of 25, especially thinking about interest rates?
They expect NI, that net interest margin, to stay pretty stable, probably in the mid 3.80s range. That assumes the Fed cuts rates twice this year, which is, still uncertain.
Right. And if rates stay higher for longer?
They see limited upside then, maybe just a basis point or two per quarter from ongoing repricing of loans and some swaps maturing. New securities they're buying, mostly agency CMOs, are yielding between 4.5% and 5%. Stuff maturing off the books is still yielding much lower, like 3% or less. So there's still some benefit there, but that gap is narrowing.
Okay, so stable and I expected. Any broader trends or regional things they mentioned? Anything exciting happening in their footprint?
They did highlight a recent Energy and Innovation Summit in Pittsburgh, hosted by Senator Dave McCormack, focused on about $90 billion in infrastructure investments across their area, including a big power generation facility near Homer City, PA, which is right near their headquarters.
$90 billion?
Yeah, their CEO is there and noted it's generating a lot of enthusiasm, a lot of optimism in Western PA that could definitely translate into future loan opportunities down the line.
Potential tailwind there.
Could be. They also talked about competition for deposits being pretty varied geographically. They're balancing, customer relationships with sometimes using competitive exception pricing to bring in funds while trying to manage costs.
A balancing act, for sure.
Yeah.
Okay, this brings us to that time.
Yeah.
Our TalkTickers Trade Idea segment. Now, remember, everyone, this is purely for entertainment, for education. It's definitely not financial advice. Please consult your financial advisor before making any investment decisions.
Got the disclaimer in. All right. So let's recap. S&T Bank Corp. Strong fundamentals, right? Excellent NIM expansion, that pristine asset quality, clear growth happening. Yet the market reaction was kind of meh initially, and that specter of the Durbin hit when they crossed $10 billion in assets, that's clearly an overhang the market is focused on right now.
Right. But they also very clearly stated they have lots of excess capital, that TCE over 11%,
Yep.
and a very clear M&A strategy to put it to work, targeting those $1 to $5 billion banks. That points to potential value creation that could, really overshadow that Durbin hit if they execute well.
Exactly. So here's the idea, the trade concept. Consider maybe a long position in S&T Bank Corp stock coupled with buying a slightly out-of-the-money, longer-dated call option.
Okay, long stock plus a longer-dated OTM call. What's the thinking there?
The rationale is this. The market seems fixated on the Durbin penalty right now. It might be underpricing the potential M&A catalyst. If S&T announces a really good strategic acquisition, one that uses that excess capital effectively, pushes them meaningfully past $10 billion, and comes with a clear story about accretive growth.
Then the narrative changes.
Precisely. The stock could see a significant re-rating. The call option is there to capture that potential upside leverage if and when that catalyst hits.
And a long stock position.
That benefits from the steady dividend and the continued strong organic performance we've been talking about, even if M&A takes a bit longer to materialize. It's essentially a bet that strategic execution will eventually overcome this short-term Durbin noise.
Interesting. A bet on M&A execution trumping the regulatory overhang.
That's the idea.
All right, that wraps up our deep dive into S&T Bank Corp's Q2 2025 earnings call. We've seen a bank that's clearly demonstrating strong operational discipline, really impressive margin expansion, excellent asset quality, all while setting the stage for some potentially significant strategic moves.
Yeah, despite that initial lukewarm market reaction, the underlying story seems to be one of a management team that's executing confidently on their plan. They've got an eye on both organic growth and using M&A. Key takeaways for you listening. Continued NIM strength, that pristine credit quality is a big one, and this strategic push for M&A to deploy that excess capital, even as they get closer to that $10 billion mark.
We hope this summary gave you some valuable insights, maybe sparked some new questions for your own research. Thanks so much for tuning in to The Deep Dive.
And remember, this information is just for educational purposes. It is definitely not financial advice. Please do your own homework.
Absolutely. So the question for you to mull over, is S&T Bank just navigating the current landscape? Or are they actively trying to chart a new course, maybe redefining what a regional bank can achieve despite these regulatory pressures and market doubts? Until next time, stay well informed.